Welcome. In this video, we will analyze Zbcn coin pump or dump. Don't forget to subscribe, like, and please watch to the end to understand. When we delve deeper into the Elliott wave theory, we can see that price movements follow a certain structure, and this structure coincides with psychological investor behavior. In the chart we are analyzing right now, the main structure is that the price is still in the second wave phase. This second wave is usually a correction phase, a time when prices take a break from the previous bullish move and the market looks for direction. This is the period when investors often remain indecisive, questioning whether the market will continue up or down. This is precisely the reason behind this sideways pricing. The nature of the second wave is that the price exhibits sideways or slightly corrected movements over a period of time. The second wave is usually the period that follows the first wave, when the market takes a short breather after a rally. In this wave, prices often decline as investors realize their profits. But this bearish nature is usually not panic selling, but a technically expected correction. While this correction can sometimes be sharp and short-lived, in some cases it can also take place over a long period of time in the form of a sideways trend. Given this technical structure, the fact that the price is currently moving sideways is a clear indication that the second wave is still active. However, this situation cannot last forever. This is because, according to Elliott theory, the second wave is followed by a third wave, which usually represents the beginning of the strongest and most aggressive upward movement. The third wave is a period when investors' confidence reaches its highest levels and buyers enter the market more strongly. In this wave, prices usually gain upward momentum quickly and previous highs are easily surpassed. From a technical analysis perspective, the target zones when the third wave begins are usually measured by Fibonacci expansion levels. These levels signal potential areas where traders can technically realize profits or new market entries. Specifically in this scenario, with the start of the third wave, the price can be expected to reach the 1,618 level as a target first, and then the 2,272 level in a broader price move. These Fibonacci levels are not just random numbers, but strong points based on past price behavior, market psychology, and the rules of technical analysis. The strength of the third wave is supported not only technically, but also psychologically. This is because it represents a period of renewed market confidence and buyer dominance, with a clear signal that the previous correction is over. Paying particular attention to volume data, the start of the third wave is characterized by significant increases in trading volume. This shows that the upward movement of the price is supported not only by technical, but also by strong participation. Therefore, the prolongation of the second wave should not make traders nervous. On the contrary, it should be treated as a lull before the big move. While the current sideways trend technically represents the preparatory phase of this big wave, it should also be perceived as an opportunity for patient investors. Moreover, when the third wave begins, prices may not only move up, but also easily overcome previous resistance levels. In particular, resistance zones that are considered psychologically important are often broken in this strong wave, and these breakouts push the price even higher. The Fibonacci 1,618 level is generally considered as the minimum target that the third wave is expected to reach, while the 2,272 level is the potential target zone for broader and aggressive rallies. Reaching these levels indicates that the market is in a positive mood and buyers are willing to take more risk. But we can't decide the analysis with only the Elliott wave. Let's look at other metrics. Stay tuned. Looking at the chart in detail, we can see that the price is currently moving in a certain narrowing structure. This structure is quite similar to the pattern known as a pennant in technical analysis. A pennant is a price structure that usually occurs during short periods of consolidation after a strong bullish or bearish move and is expected to continue in the direction of the trend. A breakout of the pennant, especially in combination with a choice of direction supported by volume, is considered the first sign of a new trend. In the region currently analyzed, the price is trapped inside the pennant structure. This pennant consists of two main trend lines, one up and one down. The upper trend line represents the resistance level that the price has repeatedly tried but failed to cross, while the lower trend line is the support line where the price reacts and starts moving up again. The price movement between these two lines creates a lot of anticipation among investors, because this kind of squeeze usually results in an explosion. However, the direction of this explosion cannot be known for certain. Therefore, the most important thing for traders to watch carefully is which level to break. The upper border of the pennant marks a resistance level that the price has already tested several times before, and sellers have stepped in. If the price can break this level on strong volume, an upside breakout could begin, which could pave the way for new highs. In other words, Breaking through the upper line of the pennant increases the chances of the trend continuing and gives positive signals to market participants. This usually encourages buyers and leads to larger buy orders. An upside breakout usually signals a continuation of the previous uptrend. However, not only the upper boundary of the pennant is important, but also the lower boundary. This is because it represents a critical area where the price has found support and reacted upwards, bouncing many times before. If this support line is broken, the situation is completely reversed. This time, the selling pressure increases and the price can quickly fall to lower levels as panicked investors sell. In such a breakout, stop-loss triggers may also pull the price down, and the possibility of a deeper correction comes to the fore. Therefore, the lower band should also be monitored very closely. Such pennant patterns often represent moments of decision. Most market participants are cautious because they don't know where the price will go, which may cause volumes to drop for a while. However, when the price chooses a clear direction and breaks out in that direction with a significant volume, then the market starts to move sharply. This is also characteristic of the pennant, a sudden reshaping of the trend after a long period of silence. The fact that the price is currently oscillating within this pennant structure suggests that it may be better for traders to remain patient rather than taking a position before a clear breakout occurs. This is because trading without determining the direction of the breakout carries a high risk. The most logical strategy in technical analysis in such situations is the wait and confirm approach. In this way, risk is minimized, and the direction chosen by the price can be accompanied with strong confidence. In addition, the amount of time the price spends in the pennant is also very important. Although pennant patterns are often described as short-term squeezes, sometimes this squeeze can last for weeks. If traders are impatient during this period, entering early and taking positions without a breakout, it can result in losses. Therefore, the best approach is to adopt a disciplined strategy, remain patient until the breakout, and wait for the signals to become clear. In pennant patterns, target levels are usually measured as the length of the pre-pennant pole. In other words, whatever the distance covered by a sharp rise or fall before the pennant formed, a move of similar magnitude can be expected after the breakout. The RSI indicator, which is frequently used in technical analysis, especially to measure momentum, shows a remarkable structure. RSI, as it is known, is an extremely valuable oscillator that allows us to identify overbought and oversold zones based on the closing prices of an asset in the last X periods. Generally, above 70 is considered overbought and below 30 is considered oversold. However, RSI is not limited to these limits. It can also generate very strong signals when combined with trend lines. At this point, the RSI chart shows that a previously downward trend line is now clearly breaking upwards. This breakout is a critical development that foretells potential price movements going forward. Falling trend lines on the RSI are often formed by combining descending peaks, indicating to traders that market momentum is waning and buying pressure is weakening. However, the moment this trend ends and the RSI line pierces the trend upwards can signal the start of a significant change in market perception, because the RSI has the potential to generate signals before price movements. RSI can go up from here. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.